Hi, John here. Part 3, Business Basics, Lesson 12, General and Administrative Costs. In this lesson, I'll discuss understanding what the G&A costs are, keeping G&A costs low to increase profits, looking at ways to save on G&A, and good spending habits should be practiced by yourself and your whole company. The best advice I can give you for G&A costs are to start small and get them smaller. Remember this very important formula for all you do. Your total income or your sales, minus your G&A costs, minus your cost of goods sold, minus your sales and marketing costs, equal your profit. G&A costs, generally speaking, are managed by your chief financial officer. What are G&A costs? Well, they're maintenance repairs, taxes and licenses, utilities such as phone, electricity, water, and so forth, professional services such as accountants, lawyers, insurance, payroll of the administration department, and miscellaneous department. Like you'll have miscellaneous costs, whatever they might be, you might put them in G&A costs. How to predict what your G&A costs will be. Some expenses can be controlled and others cannot. Expenses that can be controlled are called variable expenses. The ones that cannot be controlled are called fixed expenses. For example, your rent is a fixed expense, but your repairs and your professional services are variable. Keeping your G&A costs low over time. I would recommend that when you start, try to keep your G&A costs below 20% of your total sales income. As your sales grow, reduce your G&A percent to 15% or lower. A big expense of G&A is the payroll in the G&A department. If you also do the sales and marketing, for example, let's say you're the CEO and you're also running the sales and marketing department, then the percent that you're making in the sales and marketing department should go in that department, and the percent that you're working in the G&A department should be in the G&A department. You should split it up. For example, at the Vermont Teddy Bear Company, I spent one half of my time on sales and marketing and one half of my time as a CEO. So half of my income went into the sales and marketing department in the category, and half of my income went into the G&A category. Everyone should practice good ways to keep your costs down. Everyone in your company should keep costs down. It is important that you set the example and educate them on why. I used to tell my employees that if we spend $10,000 more on something, that means we would have to sell 1,000 more bears to make up that cost. Let's talk a little bit about a chief financial officer, a CFO, and what they do. The CFO in the company is the person who keeps track of the money, where every outgoing check or payment went. The CFO should know where every sale came from. The CFO is the person in the company who does the financial reports, monthly, quarterly, yearly, the profit and loss statement, the cash flow statement, the balance sheet statement. The CFO in a company keeps track of the budgets. The CFO puts every expense and each kind of income into an accounting field called an account. Each expense account is assigned to a part of the company expense in one of three areas: administration, cost of goods or services, or sales and marketing. The CFO is responsible for filling all government forms like taxes, business fees, etc. Many times, the CFO of a small company is the bookkeeper or the accounting firm. The CFO and the CEO, the Chief Executive Officer, review all costs and expenses and set goals and budgets for each account. The CFO needs to be very organized, needs to understand accounting, and be really good at math. The CFO is a key person in the company, very key. The CFO is one of the four key positions. Remember, the Chief Operating Officer, CFO, COO, and CMO. Every month, you project how much you think your income is going to be, and then you check it against the actual income. And then you make adjustments for the next month. That's the importance of a CFO. He makes adjustments and make suggestions so that you don't keep on losing money if your income is coming in less. You make adjustments with your production, etc. Then you might wonder, why did we not take in as much money the previous month? Maybe your advertising is not working. Maybe the formula that you have in your company needs to be adjusted. Maybe you need to increase the cost of what it is that you're selling. All these kinds of things at the end of every month, it's very important that you do an analysis of what happened during that month. Let's talk a little bit about financial reports. Briefly, a profit and loss statement is a report that tells you if you're making or losing money each month, each quarter, each year. A cash flow statement tells you where the cash went and where it came from. It's very important for you as the boss, as the owner, as the CEO, to understand your financial statements and to make sure that they're accurate and make adjustments all the time so that you can put your company in a good position. That's all for now. See you in the next lesson.